Preface. Investments may sound complex, and for those who are not aware of the different types of investments and the terminology used by investors may find it confounding in the early stages. However, once you are a part of the investment world, you will soon get used to hearing the different investment terms. In addition to the terms, investments also require prudence and a good judgment when you have to choose from a number of different investment plans. This is the reason why different investment strategies have come in place. These strategies work as a guide for many investors who are looking for assistance when it comes to investing profitably. The thing with these investment strategies is that they do not come in a one-size-fits-all form. Investment strategies vary according to the objectives of the investor. Usually, investors have short-term and long-term goals with investments. By choosing one investment strategy over the other, they identify their investment goals with the strategy they have picked. It is also important for investors to stick to a particular strategy rather than hop from one strategy to another, because it can be chaotic to change investment objectives frequently. This, however, doesn't mean that you end up sticking to an investment strategy which is not meeting your expectations. Introduction. Investments are a reflection of the investor. Conservative investors usually have a portfolio that resonates with their conservativeness, while those who prefer risks will have a portfolio that looks somewhat similar. There are different types of investing strategies that you can follow, but be sure to remember that every strategy may not suit your appetite for risk. Every strategy may not even be built in a way that can meet the investing goal that you have. There are lots of factors that come into play with investment, and it is best to understand these factors and ensure that your investment strategy fits your personality and style in the best way. These factors are your savings rate, the asset classes in which you invest, your risk appetite, your ability to diversify effectively, the investment costs. A portfolio can be built by allocating your capital to different asset classes like equities, bonds, real estate, cash, and commodities. These asset classes have varied behavior patterns of their own, which often determine the characteristics of a portfolio. Choosing the right mix for these different asset classes to ensure that your portfolio helps you meet your investment goals is very important. Some find it easier to depend on a registered investment advisor for their investments, but many established investors believe that investments can be handled effectively even without taking the help of an advisor. People who intend to get the most out of their investment may even find the investment advisor's fees to be a deterrent when it comes to taking their advice. It is not always necessary to have a financial advisor, but if you do not want to put in the time and effort to go through your investment strategies and identify the positive and negative impacts of your investments, then you may find it easier to rely on an investment advisor. This crash course is for anyone who wants to start investing. These investments can be on a small or large scale. The strategies are meant to work for a variety of investment objectives. Lesson 1. Active versus passive strategy. Investors who believe that they can time the market and trade assets in a manner that will help them outperform the benchmark indexes use the active investment strategy. It requires investors to actively monitor the markets. This strategy requires a portfolio manager who can take advantage of the short-term price fluctuations so that the investor can earn profits. This time of investing needs the investor to be confident about the person who will be handling the capital. It requires careful analysis, deep knowledge of the market, and an intuitive mind that can correctly forecast the market, most of the times. Passive investors, on the other hand, are investing for a long period of time. They usually avoid conducting lots of sales and purchase of trading assets. This way, the investor does not have to worry about the investment costs, since it conforms to the buy and hold strategy where you do not react to the market changes and instead wait for the investment to turn profitable over a long period of time. So how does an investor decide which of the two strategies will work for him? This can depend vastly on the economy and investment policies of the region in which you are investing. It is not always best to rely on a professional to actively manage your funds. A basic index fund can often perform better than an actively managed fund. However, both exist as two sides of a coin. The advantages of passive funds are that they involve very low fees because it does not require a manager to actively manage these funds. This form of investment also works for those who like transparency in their investments because passive funds usually mimic an index. But the reason why many investors choose the active strategy over passive is that passively managed funds do not promise high returns. The scope of investment is limited to the index it follows, and so the returns are also limited. While passive and active management of funds are two different strategies, many investors will find that it is easy to invest with both strategies in mind in order to bring more diversification to the portfolio. Most of the strategies we discuss further will either be an active or a passive strategy. Lesson 2. Momentum trading. Momentum trading is based on the principle that stocks that are rising in value will continue to rise while those that are doing poorly will continue to fall. This strategy requires the investors to invest in stocks that show a clear rise in value over a short period of time. At the same time, the investors dump the assets that begin to show a decline in value. This means that the total investment period in a particular trading asset is shortened so that the investor gets to increase the return on investment, ROI. Investors who use this strategy usually believe that stocks are likely to continue in the trend that they are going rather than reversing it. While momentum trading is considered to be an effective investment strategy for profitable returns, the reason everyone is not doing it is that it requires a lot of time and energy. Investors have to assess and locate the right stocks and make sure that they are always aware of the market changes because they must sell any asset that has gone cold, whose prices have started falling, and invest the money from the sale to buy hot stocks, those that are rising in value. When done right, momentum investing can be extremely advantageous since it can help the investor earn high profits in a short time. Investors who want to use this strategy should be very disciplined when it comes to investments. They may often have to stand out from the crowd and wait to make sure that the stocks are bought and sold at the right time. If a stock begins to show a decline, then it must be sold the moment it begins to show the fall, but never before the decline. As a result, the momentum trading strategy aims at buying high and selling higher. Lesson 3. Long-short strategy. The long-short strategy aims at reducing the volatility of a portfolio by investing in different types of trading instruments. It is usually associated with hedge funds, and it involves buying equities which may rise in value and selling short equities which will be falling in value. This strategy is used in many other investment strategies as well. There can be a large amount of variation in the long or short strategy used by a fund manager. Overall, the ideology behind this strategy is to take long positions in stocks that an investor expects will increase in value and short positions in stocks which the investor expects will fall in value. Some of the challenges of this strategy are that the investors have to be vigilant at all times when it comes to the changes in the market so that they can sell the failing stocks in a timely manner. At the same time, this strategy also requires the ability to correctly predict the future of the stocks in which the investments have been made. When not managed properly, a portfolio that follows this strategy may end up with a substantial amount of short positions that are not making a lot of profit as a part of the portfolio. This can eventually lead to a loss for the investor. This strategy is usually implemented by hedge funds and institutions that have deep knowledge and adequate resources for the analysis of the market so that the investments are profitable. The long-short strategy is considered to be effective yet very time-intensive. This is why fewer investors choose this strategy. Lesson 4. Fundamental analysis. Fundamental analysis is one of the oldest and most popular investment strategies used by investors even till this day. An investing style that follows fundamental analysis is one that is based on research and analysis of the equities and requires active management of the investment. By analyzing the financial statements, an investor is able to pick quality stocks so that he can enjoy better returns and lower risks. Usually, a comparison between the past and present data of an enterprise or a comparison between different companies within the same industry helps the investor identify the equities which will be most satisfactory according to their investment objectives. This investment style includes a number of different strategies which can help the investor achieve his investment goals effectively. First, value investing. Value investors are interested in financial instruments which they can buy at a discount. In doing so, they will be able to add value to their investment and enjoy a bargain. So, value investing requires looking for stocks which have been undervalued. Sometimes the stocks of a business may suffer from an irrational fall and may end up with a lower intrinsic value. Value investors intend to take advantage of this low price of the stocks, knowing that the intrinsic value of the stock is comparatively higher than the current value. The only problem in this type of investment is that an investor has to have the correct information regarding the intrinsic value of the stock. Two investors may value the stocks of a company in two different ways, according to their opinions. This is the reason why value investing uses a margin of safety, where the discount is significant enough to allow room for error if the investor values it incorrectly. While some investors consider the current value, others may also look into the future value of the stocks. However, the overall strategy of this type of investment is simply to buy financial instruments at a price which the investor feels is lower than what it is worth. So instead of going with the current value of the stock, the investor understands the fundamentals of the company to establish if the company's stocks are undervalued. Second, buy and hold strategy. Investors who believe that instead of timing the market, they should buy equities and hold on to them for a long period of time, assuming that the price of the equities will rise over time, follow the buy and hold strategy. It is a passive form of investment, which means that it does not require continuous buying and selling of shares. Some may argue that the buy and hold strategy is not as profitable as an actively managed fund because the investor gives up on taking advantage of the volatility of the market and earning higher returns, but others feel that this investment strategy can be fruitful. While timing the market can be very profitable, long-term commitments can bear great returns as well. It is considered ideal for small investors who do not want to end up paying investment costs or fees and who may not have the discipline to time the market and actively maintain a portfolio. Third, contrarian investment strategy. Contrarian investors are those who end up going against the flow of the market and investing in stocks in contrary to the crowd behavior. This means that if a company's stocks has suffered from widespread pessimism, which results in a decline in the stock prices, a contrarian investor will invest in such stocks. When the company recovers, these stocks can rise in value and provide significantly higher returns to the investor. Contrarians are usually seen doing just the opposite of the crowd, so they will be purchasing stocks when the rest of the investors are selling them, and vice versa. To a certain extent, contrarian investing is somewhat similar to value investing because the investor usually buys the stocks at a price which is lower than its intrinsic value. One of the most popular contrarian investors is Warren Buffett, who feels that stocks should be bought at a time when the short-sightedness of the market has brought down the price of a stock. Such investors usually tend to exploit the principles of behavioral finance, according to which investors as a group end up overweighing the recent trends and increasing or decreasing the value of a stock by a significant amount. A contrarian believes that price for a stock will drop too low in times of negative news, and this is exactly what happens when investors begin earmarking a poorly performing stock as a bad one. Fourth, top-down and bottom-up approach. The top-down approach relates to the strategy of looking at the bigger picture and identifying parts of the economy which are forecasted to do well. These parts are then broken down further into finer details to identify businesses in an industry which will be able to provide profitable returns. This strategy requires investors to utilize macroeconomic variables like GDP, trade balances, currency movements, and inflation to look for the high-performing sectors or countries. This means that an investor using the top-down strategy will first find out if the country he is investing in is profitable or not. If he finds out that the growth in another country will help him gain higher returns, then he may choose to move his assets internationally so that the returns are higher. Bottom-up investing does just the opposite of the top-down strategy. Instead of starting off by looking at the bigger picture, bottom-up investors look at the microeconomic factors which can make a difference in specific companies that they are watching. This means that they may look for details like the supply, demand, and the financial health of the company before they decide whether to invest in that company or not. All of these strategies are based on fundamental analysis, which means that the investor carefully goes through the financial details of the company to understand whether it is profitable enough to invest in the company or not. While it provides a good basis for choosing stocks that an investor may choose, the entire process of understanding the data and going through the financial details of various companies can be very time-consuming. This means that everyone may not be able to use this strategy effectively. Lesson 5. Technical analysis. Technical analysis is used by investors in a completely opposite way of fundamental analysis. While fundamental analysis is about careful interpretation of the financial data of the company, technical analysis is more about using charts, price patterns and current market trends to decipher the standing of a company and whether it will be profitable to invest in it or not. There are a variety of patterns and trends which help the investors identify changes in the market. They use these indicators to invest in or divest from a company. Instead of spending time in analyzing the fundamental attributes of a security, investors who use technical analysis believe that the price of the security is a reflection of the financial health of the company. So the investors aim at understanding the market sentiment related to the price of the security. Unlike fundamental analysts, technical analysts make use of historical data of the stocks of the company and try to find how the past trends can impact the future pricing of the same stocks. The three main assumptions of technical analysts are: the market discounts everything. While investors who slant towards fundamental analysis feel that it is important to consider the fundamental attributes and the intrinsic value of the stocks, technical analysts believe that the value of the company and the market sentiment towards the company have already been priced into the stock. So all that they need to focus on is the price movement of the stocks to establish whether it will be profitable for them to invest in those stocks or not. Price moves in trends. The price of a stock tends to move in a trend of the past instead of moving erratically. Short, long and medium-term trends are studied by technical analysts to find out if a stock will rise or fall in the future. History repeats itself. While market sentiments are important, most of the times a stock price repeats the trends of the past. With the help of chart patterns, technical analysts are able to understand if a trend will lead to the fall or rise of the stock value. Charts are the most essential part of technical analysis. Investors who use this strategy may use any of the following types of charts. Line charts. These show the closing prices of stock for a specific period of time. It does not take into account the intraday changes in the prices, but for most investors, closing prices matter the most. The line is formed by connecting the closing prices of each day over the period of time depicted in the chart. It is a very simple chart and makes it easy to understand the trend when compared to other charts. Bar charts. Investors who want insight about the high and low price of the day and the opening and closing prices of the stock will find this to be more suitable. Candlestick charts. These charts get their name from the candlestick-like bars that represent data for each day on the chart. The chart shows the opening and closing prices and the difference between the two. Point and figure charts. Not as popular as the other types of charts, point and figure charts are used by fewer investors. These charts use a series of XS and OS to show the rise and fall in the value of a stock. The XS show a rise, while the OS show a fall. Time is not clearly represented on the chart, so it helps remove noise from the charts. Chart patterns. Technical analysts use different chart patterns to find out if they are investing in the right stocks or not. A chart pattern will usually show reversal or continuation, which helps the investor understand what may happen next. A reversal pattern suggests that the current trend will soon reverse itself, while a continuation pattern shows that the current trend will repeat itself after the pattern completes. Here are the most popular chart patterns that technical analysts use. First, head and shoulders. Second, cup and handle. Third, double tops and bottoms. Fourth, triangles. Fifth, flags and pennants. Sixth, wedges. Seventh, gaps. Eighth, triple tops and bottoms. Ninth, rounding bottom. These patterns require careful study to understand how the stock value may be affected in the future. While trading, these patterns are used by technical analysts to form a strategy that can help them invest for higher returns. All of these patterns get their name from the pattern they form on the chart. To the average investor, this may look very complex, but once they start reading the patterns regularly, it will start making more sense. Lesson 6. Pairs trading. This strategy is used by investors to monitor two securities which are historically related and when the correlation between these two securities weakens, which implies that one stock rises while the other falls. Then using the pairs trading strategy, the investor will short the outperforming stock and hold the underperforming stock for a longer time. It is based on the idea that eventually the prices of the two stocks will converge and the investor will be able to take advantage of the temporary change in the prices. These changes can be the result of sudden reactions to negative or positive news related to any of the two companies. This strategy started somewhere in the 1980s by Wall Street's Morgan Stanley and Company. A team of computer scientists, mathematicians and physicists came together to study the equities market and identify the ways in which market imbalances can be exploited. They found the basis of pair trading and used it to help Morgan Stanley gain a profit of $50 million. However, the strategy did not work very effectively in the next 2 years and the idea was subsequently dropped. In recent years, pair trading has started gaining traction once again because of the ease of access to the internet and advanced technology for investors. It helps the investors look at real-time data quickly and easily to identify imbalances which they can monetize. Examples of pairs that are correlated are Coca-Cola and Pepsi, Walmart and Target Corporation, and Renault and PSA Peugeot Citroën. While pairs trading is considered to be a comparatively safe strategy, there are still certain risks where investors may end up with losses. Sometimes the two stocks begin to drift apart and the correlation weakens to an extent where both the stocks start trending instead of reversing to the original mean. This change in the mean may or may not be profitable for the investor. Lesson 7. Dividend growth investing. Dividend growth investing strategy is the strategy of buying stocks in a company which pays quality dividends and where the dividends continue to rise over the years. Dividend growth investors look for companies who increase their dividends at a rate which matches or exceeds inflation every year. This strategy requires the investor to hold on to the stocks for a long period of time, sometimes even decades, to make sure that they can benefit from the dividend payout and deferred taxes. It is best to diversify the investments in such companies over different industries and sectors so that their investments are spread over various areas of the economy instead of relying in just one area. An increased dividend shows that the company is growing its earnings. Dividends are real. A company cannot simply fake dividends. This is the reason why dividend growth investing is considered to be an effective way of investing in stocks for profits. Companies that have a stable business model and a rising cash flow can consider increasing the dividend, which means that dividend growth investing is a strategy that can help investors find stocks which are likely to provide good returns. Investors who follow this strategy benefit from getting paid to wait while the capital appreciates. Since these companies provide growing dividends year after year, the stocks usually have higher chances of capital preservation. Dividends also help investors create a steady income in addition to their regular source of income. While most companies pay dividends in a quarterly basis, when invested prudently, investors will be able to enjoy dividends from different companies in different months, helping them turn it into monthly income. This strategy is gradually coming back into style as more people begin to realize the benefit of investing in stocks which will bear a steady income for them. Lesson 8. Dollar cost averaging. This investment technique requires investors to buy a fixed dollar amount of a particular investment regularly without focusing on its share price. The only difference is that the investor ends up buying more shares when the price is low. On the other hand, when the price increases, the investor buys fewer shares. Dollar cost averaging works on the basis that the average share cost will eventually lower and increase the opportunity of the investor to profit. This strategy requires the investor to invest a fixed dollar amount every month. The portfolio of the investor can vary according to their risk profile, but the idea is to begin a fixed amount of investment every month according to their investment objective. Instead of investing one lump sum amount on a single day, dollar cost averaging is used to spread the investment over a period of time. For example, an investor invests $1,000 every month for 5 months in a particular stock or mutual fund. In the end of the 5 months, the shares purchased every month amount to Month 1, shares bought at the rate of $20 equals 50 shares. Month 2, shares bought at the rate of $16, 62.5 shares. Month 3, shares bought at the rate of $12 equals 83.33 shares. Month 4, shares bought at the rate of $17 equals 58.82 shares. Month 5, shares bought at the rate of $23 equals 43.38 shares. Total number of shares equals 298.14. Average cost per share equals $16.77. Keeping in mind that the price of the shares has risen to $23, it shows that the investment of $5,000 has grown into $6,857.11. If the shares were purchased as a lump sum in any of these months, then the investor may have a higher or a lower profitability than $6,857.11. Dollar cost averaging is a safe way of investing in shares or fund so that the user ends up profiting from the investment over a period of time. Lesson 9. Small company investment. Data makes it evident that smaller businesses have done well historically in the stock market when compared with large-cap companies. The best returns are usually from micro-cap or small-cap companies. Investors who use the small company investment strategy usually invest in small-cap companies in the stock market. Warren Buffett, who is known to have accumulated his fortune through judicious investments, is known to have invested in small-cap companies in his early years of investments. The problem is that there are a number of small companies coming up all the time, and it is important that you pick the right companies or else you may end up with lower than expected returns for your investment. An investor who uses this strategy should look for companies with a higher gross margin. Gross margin is the difference between the revenue earned by the company by selling the goods and the cost of producing the goods or the cost of the goods sold. It is important that the company should be able to earn adequately and has a gross margin which allows the company to invest in other areas, like marketing and distribution. Another aspect to keep in mind while investing in small companies is the management. Since small companies greatly rely on taking the right business decisions to spur growth and help you get desired returns, you must do some research on how strong the management team of the company you wish to invest in is. There are other factors, like the strength of the brand and the overall market sentiment related to the brand, which can make a difference as well. But depending on your choice of small companies, you may have the chance of earning higher returns than what you may have expected. Smaller companies benefit from the fact that they have a better exposure to their domestic economy, but they are protected from the changing landscape of international trade. Since political leaders are growing more protective of their homeland and are encouraging the use of national products, small companies are beginning to provide a cushion to investors from the volatility of the global trade. Small companies also tend to grow faster, and they are known to value innovation and dynamism, which helps them stay ahead of the competition. But the downside of investing in these companies is that the chance of risk is very high. There is a possibility that it may not work and that the business ideas proposed by the firm may not be accepted by the consumers. This can lead to sudden changes in the pricing or valuation of the company and its products, directly affecting your investment in the company. Another problem faced by small business investors is the liquidity of the shares. They may find it difficult to sell the shares of a small business quickly and easily. This is especially the case when the business may not be doing well and the investor is trying to get rid of the shares before the prices fall too low. Investors looking for an income may not find this strategy to be an effective one, either because smaller companies tend to reinvest their profits to grow the business, while large companies that have been established for a long time have a higher chance of distributing the profits in the form of dividends. Lesson 10. Indexing. Indexing is a passive investment strategy, which is popular because of the low costs involved in it. This strategy aims at generating a rate of return that mimics the rate of return of an underlying market index. This means that an index is replicated through the investments, creating a portfolio which bears the same weightage as the stocks in the index it is mimicking. This strategy is used by investors who believe that it is almost impossible to beat the market. This is why a market index is mimicked to help investors earn at the same rate as the market. These are considered to be relatively passive because they do not require a fund manager to decide the funds that have to be invested in. The investment simply mimics an index. This also means that indexing saves the investors a lot of costs that they may otherwise incur when investing in an active fund management strategy. Indexing, however, is profitable only when the investor has a number of indices to choose from and when these indices offer competitive rates of return. Certain economies may not allow investors to enjoy the benefits of indexing since there are a limited number of indexes that can be followed. India, for instance, has only 2 indices which can be mimicked. This means that the investors do not have a lot of choice and the opportunity of beating these 2 indices is higher through active fund management. In countries like US, index funds are more profitable because there are a number of indexes which can be mimicked and each of them offers competitive rates of returns. This makes index funds more profitable and reduces the chances of beating the indices. As a result, index funds are known to provide satisfactory rates of return in the country. Lesson 11. No strategy. Lastly, there are investors who do not use any investment strategy at all and instead trade on the basis of information they may gather from friends, family members and other investors, or they may simply trade on emotion. The behavior of a sheep is the complete opposite of bulls and bears in the trade markets. While bulls and bears are known for their prudent decisions, which are taken on the basis of following the market closely and using a strategy to choose the stocks that they should invest in, sheep do not have any strategy and they do not follow the market as closely either. It is considered that these investors usually end up with market losses because they do not have any strategy of investing their funds in the market. Just like the sheep follow a shepherd, these investors end up following financial pundits, the latest market trends, or reacting to market stories. Their investments are usually based on market discussions instead of reliable data or information. Without a strategy, they are usually clueless about the different opportunities available for investment and the ways in which they can make the most of their investments. It can also get difficult for a sheep-like investor to meet his investment goal within a specific period of time, since they do not have a strategy in place to ensure that their objectives are met appropriately. An investment strategy prepares the investors for risks and helps them come out of hard times more easily than investors who do not have any strategy in place at all. While strategies may evolve as you set new investment goals, but not having one at all may only refer to the short-sightedness of your investment objectives. To make sure that you make the most of your investment, it is always best to have a strategy in place. Conclusion. In addition to an investment strategy, investors also have an investment philosophy in mind. This philosophy acts as a guide for them as they establish new investment goals and embrace new strategies. Your investment philosophy includes the principles and practices which dominate the decisions you make for your investments. An investment philosophy is aimed at helping investors control their emotions and focus mainly on what matters most, their ideology behind making an investment. Investors may have short-term as well as long-term goals when they invest. An investment philosophy helps them in the decision-making process for all these goals and ensures that in the long term they are able to benefit from their investments. It helps you take rational decisions regarding the investments and ensures that you follow your investment strategy with great detail. Your investment strategy is a manifestation of your philosophy and it will include components of your ideology. You may have to adjust your strategy with changing times and changing perceptions of the market, but your philosophy is your guide, which helps you make sensible investment decisions. An investor may end up using more than one investment strategy to identify the investment which will be profitable for him. Among all these investment strategies, there is no such strategy which can be used by all the investors. Depending on the investment objectives, risk appetite and the amount of money a person will be investing, different strategies can be utilized. Every strategy is useful in its own way, and each one of them carries its own set of advantages and disadvantages. The strategy used by the investor is simply a means of ensuring that they are able to invest wisely with the least risks possible. An investment strategy is in no way an assurance that an investor will not end up losing money or that their investments will definitely earn them higher returns. These strategies are only used as a guideline to help the investors identify the financial instruments in which they can invest with the least amount of risks. Alleviating risks is hardly possible in the investment market. In the end, all strategies aim at predicting the future in one way or another. Keeping in mind that the future cannot be controlled, risk is a factor that can never be ruled out of the investment market. Different strategies are useful for different types of investors. Some strategies require excessive time and effort, where the investors may have to study previous data, financial information, and other details of the company to identify if the company will provide profitable returns. Whether you are professional or a new investor, knowing and understanding the different strategies can be extremely helpful. It gives you the opportunity to understand the ways in which you can invest and the most sensible investment that you can make in order to achieve your investment goals.